What's going on, stock traders? It's your boy, What the Duck here, and it is time for another trading class video. This is a bonus class going over the difference between stop orders, limit orders, and trailing stop orders. So let's go ahead and get right into the class. A limit order is an order to buy or sell a stock at a chosen price or at a better price. So for buying, the order will only be executed at or below your limit order price. And for selling, the order will only be executed at or above your limit order price. So for buying, it's at or below. For selling, it's at or above. So think of it this way. With limit orders, you are selecting a price that is better than the current price for you. So for buying, you're looking for a price lower, because for buying, lower is better than the current price. And for selling, you're looking for a price that is higher, because for selling, higher is better than the current price. So the limit order guarantees that you will pay the price you select or better if your order fills. This is not guaranteed, however, because if the stock does not reach your limit price or there is not enough volume, your order might not get filled. If you're worried about this, you can select a market order, and this order will execute as fast as possible at the current market price. So let's go ahead and look at an example. This is actually from the handout, which you can check out at Pennybois Discord. It's a free class. You will have access to this free trading class, and I will show you how to find it in a little bit. But for example, stock XYZ is currently at $200, but you think that that's too high. You think it's going to fall down to $180, which is where you feel more comfortable buying. So you would set a limit order to buy for $180. So if the stock drops to that price, then you'll purchase the shares at $180 as long as there's volume. Example 2, now let's just say that you bought the stock at $180. Now you want to sell it at $220. So you would set a limit order for $220 to sell. And if the stock rises to that price, then your order will fill, meaning that you will sell your shares for $220. Once again, as long as there is volume. So next up is a stop order. A stop order, sometimes known as stop loss, is an order to buy or sell a stock when the price is at a chosen price. So when buying, using a stop order, you are placing your buy price above the current price. Why would you want to buy above the current price? This is typically used by short sellers who are looking to buy back their shares at a certain price in order to limit their loss. The short selling, which we will go over in Pennybois University. Short selling, they are selling their shares and then they have to buy it back. And just to limit their loss, they want to have basically it's their version of a stop loss. But for them, they're buying it back. So for them, they're putting a stop order to buy above the current price to limit their loss. So for instance, the stock is trading at say $20 and then high of the year is $21. Or there's a resistance at $21 that you think that once it breaks $21, that stock is going to fly. It's going to go up and you're going to make some profit. But if it does not break $21, then you don't think that anything's going to happen and it won't be a good trade. What you can do is you can set a stop order to buy at $21. That way, if the resistance or the high a day does get broken, then you are buying and taking advantage of what you are hoping would be the momentum going up from breaking the high day or breaking that resistance. So when selling a stock with a stop order, you are selecting to sell at a price that is below the current price, and this is known as a stop loss, and this is the most common way of using these stop orders. It's a way to limit your losses in a normal stock buying transaction. So you bought stock XYZ at $200. The stock is dropping, going down, and you don't want to end up being a bag holder. So what you can do is set a stop order at $180 to limit your losses and limit your risk. Once the stock drops to $180, your order will fill if there's volume. That way, let's just say the stock keeps going down, you're saving yourself from even greater loss, because let's just say that you're okay, losing $20 a share. That's why you have a stop loss. If you don't have a stop loss, you could risk the stock going down to $160. And if you're not okay selling there, chances are you won't be okay selling when the stock goes down to $140 or $120 or even $100. And then you're stuck holding a bag for a long time. Your money is stuck in that stock, and instead you could be using that money to make money elsewhere and make that loss that you had from having a stop loss. You can use that money that you now are bag holding. You could have used that elsewhere to make that money back. But instead you're holding a bag. Either A, you sell for a loss anyways, an even greater loss than if you had a stop loss, or B, you have to wait 3 months, 6 months, a year for your stock to eventually come back to maybe just even breaking even. So the next example is you bought stock XYZ at $200. the stock is rising. Price is now $250. So you want to keep your shares in case the stock keeps going up, but you want to make sure that in case it drops that you're able to sell for profit. So you can set a stop loss at $240 to sell. This way the stock begins to sell off or go down, your order will fill if there's volume to sell at $240, and you'll be walking out of that trade with profits. Now, if you did not have a stop loss in this situation, started going down, it could have gone to 240, then 230, then 220, and then eventually to $200, and now you have zero profits, and chances are you're going to be feeling a certain way because of that. You might have some emotions, and you might end up revenge trading or having FOMO, and for all you know, you could end up taking a loss on that trade. This is why we like to limit our losses and also make sure that we protect our profits. So if the stock keeps rising to $280, then you can just move your stop loss as the stock goes up. So in this case, you can move your stop to $270 to guarantee that you make profit. Let's say the stock keeps going up to $300, you can move your stop to $280 or $290 and keep doing that as the stock goes up. That way you are making sure that no matter what happens, you are still walking out of that trade with profit. A trailing stop loss, typically used by day traders to protect their investment, while at the same time making sure they are not limiting themselves to potential upside or price rise. So you set your stop loss at a certain price and then you select your trail. This can be either a dollar amount or a percentage. When the stock moves up your selected trail, well then your stop loss will move up with it. Let's go ahead and go over an example because I know this can be confusing. Again, we're going to go to the handout. So example, you buy a stock at $20. You set a 10-cent trailing stop loss. So your trail is 10 cents and you set the stop loss at $19.90. So remember, your trail is 10 cents. So when the stock moves up your selected trail, which in this case is 10 cents, then your stop loss will move up with it. The stock goes up 10 cents, which is your trail. So the stock goes up 10 cents. Now the stock is at $20.10. So your trailing stop loss, which used to be at $19.90, well, because the trail happened, now your trailing stop loss rises with it. It rises up. Your stop loss goes from $19.90 to $20. So the stock goes up another 10 cents to $20.20. Well, your trailing stop loss now goes up 10 cents with it to $20.10. So let's say the stock moves down only 5 cents to $20.15. Your trailing stop loss stays the same because your trailing stop is 10 cents, not 5 cents. That 5-cent move does not do anything to your trailing stop loss because your trailing stop loss only moves if the stock moves based off of your trail, which is 10 cents. So a 5-cent move does not affect that. But typically, people won't have such a small trail, like a 10-cent trail. They might do like a 30-cent trail, whatever it may be, depending on what their risk versus their reward strategy is for that trade. But this is just an example. And another example is, let's just say you bought a stock at $5 and the stock is currently running and is now at $8. You can set a trailing stop to make sure that the stock drops a certain percentage of price. You will be able to sell for great profit while making sure that the stock continues to rise. Well, you won't sell too early and you won't miss out on gains. This is great for volatile stocks that tend to go up and down pretty quickly. So one way of using a trailing stop loss is a parabolic SAR indicator, which we actually are going to be having a class going over it. I'm not going to go over this in too much detail, but this is basically what the parabolic SAR indicator is these green dots, the red dots. In this case, these green dots would be your trailing stop loss. So this is kind of how a trailing stop loss works. As the price goes up, your stop loss moves with it. So you could have set your stop loss at, let's just say right here at $55.17. But as the stock goes up, your trailing stop loss goes up. The stock starts to go down, your trailing stop loss stays the same until the price reaches your trailing stop loss, and that's where you would sell. As opposed to if you just set a regular stop loss here at like $54, you would still not be selling up here because your stop loss stays the same because it's not a trailing stop loss, and you would miss out on all this profit as the stock goes down. So like I said, there are a couple of charting indicators you can use as a manual trailing stop loss, one of them being the parabolic SAR indicator, another one being the super trend indicator. We will be going over both of these in detail in our bonus classes. If you go to our Discord, you join for free, you get access to our free trading classes. You just click this channel right here and you have a bunch of trading classes. You have your super trend indicator, you have this one right here, the bonus stop orders versus limit orders, and I will be putting more as we go on. There'll be a lot more free classes coming available to all of our members because we believe that everyone should be able to learn how to trade, or at the very least get started, which is why we have these free classes here for you, like the Options Trading 101, Trading During a Red Market. We also have our PBU Learning Center, which you can definitely take advantage of. You click that, go all the way down, that you can see our table of contents. And basically this is just a bunch of trading tips and tricks that you can use. We have different videos you can use, trading lingo, how how our Discord works, how our buy-in method works, which is very important. We have different calculators and different spreadsheets you can use. We go over how to day trade with a cash account. We go over how pattern day trading works, different types of buy and sell orders, which we actually just went over today. So if you want to go over that in more detail, you just scroll up, and different types of buy and sell orders. What is a stop loss? What's a market order? What is a limit loss? A limit order? What is a stop order? And so on and so forth. We also go over like OCO orders and other great different strategies you can use as far as buying and selling stocks. We go over some pros and cons of Webull, and of course trading in after hours and pre-market, how to set a stop loss and a limit sell at the same time, which is really important. So definitely check all this out. We go over candles, we go over trading psychology, options 101, the Greeks, spreads when it comes to options, and different just different tips and tricks when it comes to your trading. So definitely worth checking out. And if you are on the Webull desktop version, this is where you can find limit, market, stop, limit, which is the combination, which we go over in the PBU Learning Center, and trailing stop. So we went over all this. And then we also have in the PBU Learning Center how this all works with the quantity, the limit price, extended hours. If you're trading during after hours, you have to make sure that you have extended hours. That is the end of our trading class video, or bonus trading class. I hope that you join us next time. We have a bunch of these bonus videos going on our Facebook. So I hope to see you then at our next class. I hope to see you in the Discord. You can message me What the Duck with any questions you might have. But until then, I hope that you all make some bread.